Welcome to the Breakthrough Advisor Podcast. In this podcast, we inspire advisors with ideas and pathways to break through barriers and build a thriving retirement income business. We will interview innovative technology developers, business leaders, and successful advisors, then help you organize and execute these ideas to move your business forward.
Hey folks, this is Jack Martin. I serve as the virtual CMO for Simplicity InsurMark. I want to welcome you to the Breakthrough Advisor podcast today. This is where leading advisors from all over the country are coming to level up their practice, to hear from great thought leaders, educators, trainers, and superstar advisors like our guest today, Debra Taylor. Debra, thank you for joining us. I know we're in Q4, and I assume this is go time for you and your team, right?
Yeah. Right. We're
So
running down the clock.
thank you for squeezing us in. I really appreciate it. So share a little bit about what it's like, for your team, this time of year, because you're tip of the spear when it comes to tax planning. You teach it, but you also practice it, right? So what's it like for your team now?
Yeah. And so, it's sort of interesting because it's a little bit of what you would expect and a little bit of what you wouldn't expect, right? So year end is obviously a run up against the clock, right? December 31st, there's no do-overs, there's no give backs. You can't wake up on January 1st and be like, oh, oopsie, and so we are in that, sort of that last season. Interestingly enough, a lot of people, unfortunately, think of Q4 as tax planning season alone, but a great tax planner thinks of tax planning as a year-round sport. So we're doing tax planning throughout the year. And what it does then is, first of all, you're providing service throughout the year, which is really important. And we can go into all kinds of detail around that. What it does, though, is it does take some of the pressure off Q4. So yes, is it busy? Sure it is, because some of the people who put us off all year didn't really focus on this. Oh, I have until December, so I'm not going to worry about that now. Now we have to do this, right? It has to be done before December 31st. So yes, there's a sense of urgency and a sense of busyness. But having said that, we view tax planning as a 12-month-a-year activity.
As well you should. And I know in the webinars we've done with you, you talk about the things you do throughout the year. So we won't get into all that detail. But some of the things that happen in Q4, so my DNA is financial advisor. So 3 decades CFP, RIA, ran a large branch office for advisor group, et cetera. So I know in Q4, the unexpected happens, right? So there's a death, there's a birth, there's a new job, someone gets fired. There's all sorts of different windfall situations that potentially impact income, estate, or gift tax. So how do you deal with that, all of those pieces then?
Yeah, I think so. We plan for the knowables, right? Like the known knowables, right? So we're planning for those, but we know that the unknowables, right? The unexpected things are going to happen, whether it's during Q4 or throughout the year. And that's where, to me, process and checklists are so important. And so if there is a death and that shows up in December, we have an entire checklist as to how to approach these things. So in all the madness, we're super busy. Boom, we have a process. Everybody knows what's expected of them.
Gotcha. So speaking of income, estate, and gift tax, there are a few changes coming up next year, right? So how are you setting the table for what's supposed to happen next year?
So we've been talking to our clients about this actually for years, particularly the estate planning part of it. Those clients that I say who are in the splash zone, which means people that would feel exposed if that lifetime exclusion was cut in half. And so for those people, and what that would mean, by the way, is let's say someone who's single, who's at maybe 6 million or so. If it's a married couple at 12 million, right? We've been having these conversations for the last several years because we know that estate planning requires a lot of runway. And we also know that Congress will pass laws that last 2 weeks of December, right? We've been seeing this. TCJA was passed the last 2 weeks in December. Secure Act was pushed through the last 2 weeks of December. And by the way, one of their other techniques is that they don't talk about it going into December. And the reason they don't talk about it is they don't want to galvanize the opposition. So they've become very sneaky about passing this tax legislation, attaching it to must pass legislation, whatever angles they have. And so the estate planning, we want to get ahead of that. And the thinking then is, if you are going to do this anyway, if you are going to gift anyway, right, then why not do a little bit of that now? Let's engage that estate planning attorney. Let's go through some of these preliminary conversations. Maybe let's do a little bit of this gifting or a little bit of this trust establishment, right? Maybe not all of it, but some of it. And then if we see things heading in a direction that don't look favorable to us, then we're teed up, we're ready, we've already done some of this work, and we've already had the challenging conversations to know what should come next. So that's from the estate planning standpoint, conversations we've been having now, like for literally years. From the income tax perspective, again, so much is going to depend what happens in the next month and a half. And so all eyes are on Washington. We know that the R's and the D's are viewing income tax very differently, okay? And the one thing we're seeing is neither of their programs is fiscally responsible, right? Is the budget crunchers are all saying, whether it's the Democrats or the Republicans, the things that they are out there promising, they're not going to be able to deliver on all of those things. And so, yes, we're watching it closely, but really what it comes down to at this point now is let's see what happens with that election. And then as soon as we have clarity as to the Senate, the House, and the presidency, then we're off to the races, and we'll know at least directionally, right? We're not going to know everything right away. It's not like whoever wins is going to implement a tax program the next day, but we will know directionally what we need to worry about or not worry about. And then we'll be hopping on top of that with our clients.
And there's still a little bit of a window left, right? Because they don't expire until the end of next year. So you've got a little bit of a runway left.
100%. You're absolutely right. Is we have basically a little bit over a year for the TCJA. And so this is going to be a really important year. And I do believe, and we're seeing it already, taxes are at the forefront. Is every day or every other day, they are on the campaign trail and they are talking about taxes. So we know it's going to be a pitch battle. It looks like the Senate, will stay Republican just because of the way those numbers work. But it's going to be very interesting to see the presidency and the Congress figure out what that split looks like, if there is a split. And you're right, technically we have until the end of next year, but the TCJA does expire. And so this is the thing that clients need to be aware of. They think that this is like an option, okay? Like, oh, I can just ignore this. This is going to be okay. Trump's out promising this, or Harris is out promising that. The TCJA sunsets at the end of 2025, and all these folks are going to have to get in a room and hammer this thing out. And in a way, the expiration of the TCJA gives an edge to the Democrats. And I'm not trying to be political here. I will be critical of all parties and all candidates, okay? But the expiration of the TCJA gives an edge to the Democrats because now they're coming to the table and they're like, TCJA is expired. So on some level, we can start from scratch. Now that's a little bit of an overstatement because also at the end of the day, over 2/3 of the American public has benefited from the TCJA. And when I say benefited, has lower taxes. It's over 2/3. And so you've got a lot of people at a lot of levels, not just the wealthy, right? Because 2/3 have benefited. So a lot of people that are becoming heavily invested in at least portions of the TCJA. And that's where it's going to get tricky, right? Do we retain that SALT limitation, or do we lift the SALT limitation and allow the unlimited state and local tax deduction, right? Get that back in play. And so there's aspects of the TCJA that everybody has become invested in, because if you've got 2/3 of the American public who's benefiting, then you've got a lot of folks out there that might not like all of the TCJA, but they're going to like enough of it that they felt like they were winning. So the Democrats also don't want to look like they're completely torpedoing the TCJA either. So it's going to be really interesting to see what happens. But here's what I tell you, bottom line, taxes are front and center. There's no question about it. And every one of our advisors out there needs to be following this closely and needs to be in front of this with their clients. And I'll tell you one other thing in connection with this. So we have an election in a little bit over a month. And it was interesting going back 4 years when we had our prior election. And there's so much out in the press, right? All the talking heads on Sunday morning, right? All the newspapers are covering it. So I didn't do a lot about it when Biden got elected because I thought, oh, you're hearing from so many people. Well, I had a client advisory board right around the election. Okay. And they said, what are your thoughts on this, Debbie? And I said to them, does it really matter? You're hearing from so many different people about the election and about tax policy change. And they said, yes, it does matter. We want to hear from you because you're our financial advisor. And I thought, holy cow, like I totally missed this. In my desire to be humble, to be honest, and not think my opinion's that important, my clients are saying just the opposite to me. And so what we ended up doing is we had a special post-election webinar right after election. We hastily put it together then, and it was very highly attended. And by the way, already scheduled for a little bit over a month from now is another post-election actually party at my house where we're going to speak about the election, speak about where we think directionally tax policy may be going, and coupling that with a social event at my house. So just a thought for our advisors out there is, again, you want to stay ahead of this.
Yeah, so there's a lot to unpack in what you just said. Great job.
I know.
The thing about being proactive in communication, so obviously that's thing one for financial advisors all the time on all subjects. Be proactive, be communicating, right? And so the thing that you layer on top of this is how much clients want their advisors to provide them with tax planning. I mean, it's off the charts, and it really doesn't matter the income strata or the net worth. At some level, everybody wants to hear from their advisor about what they need to know about what's going on, okay? And you're absolutely right. You are the lighthouse that's cutting through all the fog of what's going on in the media. So that's super well said. And I love the idea of the party. Great way to get a twofer, right? A little social activity, bring a friend, get some more referrals sort of thing. Very, very, very good idea. So one of the things that I think gets lost in this is we're so focused on the fire that's about to break out, we forget the fact that there's going to be life after the fire, right? So where are you on the idea of tax diversification? So in terms of having, not have, so many of us have so much of our net worth tied up in 401k and IRA, right? So we don't have much taxable income. We don't have much tax-free income. We've got a lot of tax deferred income. How do I weave that, or should I weave that into the conversation while we're talking taxes?
Yeah, I mean, I love that, Jack, because I think asset location is the unsung hero of tax planning, is how I put it when I talk about it. If you look at asset location and doing it well or not doing it at all, it literally impacts your clients' portfolios by millions and millions of dollars. And now, even more so, because what a lot of folks are doing is they're taking these technology stocks, they're putting them into their IRAs, and now they're showing up and they're like, oh yes, I have, $6 million or $10 million due to NVIDIA or some other technology stock, and it's in their traditional IRA. And I'm like, well, that's just a train wreck.
Wait. No. This is a good problem to have. This is a good problem to have, okay? But it is a problem that needs solving, right?
Again, I need to build up my expertise a little bit. So I got to create a problem so that they'll hire me to solve the problem, right?
Correct. 100%.
But something, we're seeing this far too often, particularly with these, really large accounts. And so when you run the numbers, it's literally millions of dollars that is being left on the table that's getting paid to the government. So I completely agree with you. And I'm seeing it much more now than ever before.
Is there a rule of thumb there? I mean, should you think about, more or less equal parts in each of those three kind of accounts, or?
Yeah. So you've seen rules of thumb in the past, and, I've written articles on this. I'm really against these rules of thumb now, Jack. Okay. Because we have the tools to do the analysis. So rules of thumb made sense when we didn't have the technology, right? If we go back, I mean, you've been at this a long time. I've been at this a long time, right? Someone come to you, they say, hey, I'm thinking about getting a bonus, but I could put it to next year. My income's about $250,000. And you'd pull out a sheet of paper and you'd be like, oh, let me scratch this out. Or you might have the like little chart that you have, right? The little chart. And you'd say, oh, well, you're at 250 now. And now if you throw that $50,000 bonus on, that would just push you into the next tax bracket. So maybe don't take that bonus now, right? You and I both did that, right? And maybe we both did that more recently than we care to admit, 5 years ago, 10 years ago, definitely 20 or 30 years ago, right? That's those rules of thumb, essentially. That's that back of the envelope calculation, right? I don't want to hear about that anymore because we have the technology to be super thoughtful and to give precise and high conviction recommendations. And so here's what I do with the asset location issue, right? Is if you model out for people what their potential tax bill could look like down the road if they never met you and they don't do any of this asset location, any of this tax planning. And you're like, oh my gosh, Debbie, like that sounds like a huge headache. Well, guess what? The accumulation software allows you to do that, right? Is most of the folks listening to this podcast are already using their accumulation software. That's your eMoney. That's your Money Guide Pro. And the data shows that literally 2/3 of us are using one of those softwares. We're using both. Okay. And so 2/3 of you out there are already doing this, right? You already have put a plan in eMoney or Money Guide Pro. And of course it could be Right Capital, one of the others, whatever, right? And if you sit down and, there's 60 pages, 90 pages that you could print out. So this might be the part that you never really thought about or never really looked at in this way. But if you look down the road, you can see their tax bill, right? And you can see that this guy that's plugging money into his 401k/IRA every single year, and if he keeps doing that, you can see that they're going to have RMDs of $400,000 when they're 80 years old, and they're going to have a $200,000 tax bill, like, right off the top. Okay. And so then you look at that, and here's what I say. You plan now with the end in mind, right? So if you look at what the end is going to look like and you see, my gosh, if we keep doing this, my client's going to have $400,000 or $500,000 of RMDs, and we know that's a train wreck. Now let's pull it forward and say, hey, you can't be putting, and think about the amount of money, by the way, that is going into these 401ks with all the catch-up contributions. It's literally like $70,000 a year. If you're putting $70,000 a year into these plans and you're doing this every year, you can see very quickly how this is going to be a problem at the back end. And so now you have the person sitting in front of you and you're like, we have got to stop the bleeding is what I call them. I've got to stabilize this situation, and we can't keep making it worse by you putting $60,000 or $70,000 a year into your 401k and your traditional IRAs. And that's when then the negotiation begins. And maybe we split it. Maybe some goes into the Roth, some goes into the traditional. Maybe they'll listen to you and put it all into the Roth because you've scared them enough. But that's how you do it. And then, by the way, if you want to go deeper than that, that's when we can pull out the distribution planning software and get into the real technical stuff. But you don't even need to do that. Just look at your accumulation software. It's already telling you a story.
Yeah. So I love tax triage. Okay. So yes, to stop the bleeding, but in my experience, the next step is treat for shock. So when you start saying, no, you're not going to put 70K in, the eyes get big, the breathing gets heavy. What do you mean I'm not going to put 70K in it? Well, let's dial it back. All right. Let's put a pressure dressing on this and make sure that you're going to be okay. So you're absolutely right. It really is a numbers thing. So well said. Excellent job. So we were talking about estate planning kind of at the top of the show, and this whole thing about next generation. All right. And so getting the $6 million IRA passed on to the next generation. So how are you folks looking at next generation planning? How are you looking at getting access to that next generation, having a presence, having a relationship? I mean, how are you guys thinking about that?
Yeah, I love that, because honestly, it's an area that we have not been as strong as I've wanted to be completely candid, right? So I guess it's got to be a multi-front approach. So one of them is from Jack's like, I like that. So one of them is from the tax planning standpoint. And so from pure tax planning, that Secure Act has created a huge headache for multi-generational planning, leaving money to heirs. And by the way, how much business have all of us closed due to the Secure Act? Right? Due to the Secure Act. So from a multi-generational planning standpoint, I will talk to clients about the three ghosts, right, is what we call it. And so part of, right, so Jack's smiling, right? So part of what we talk to them about, and again, there's a number of ways to approach multi-generational planning, but one of the ways is talking to them about that IRA and about the problems it's going to create. And that's those three ghosts, right? So it's ghost of Christmas future, right? Particularly if they're a little bit older and RMDs are about to start, right? Is, hey, look, this is what your tax bill is going to look like in a year or two when RMDs start, right? That's already a headache for you, okay? So I sat with somebody earlier this week, and their RMDs in like a year or two were going to be like $300,000 or $400,000, just right off the top, like right out of the box. That's what we're starting with, right? So that's ghost of Christmas present. For some people, it's enough to get their attention. Boom. All right. Then I have ghost of Christmas, like ghost of Christmas future, which is if you're a couple, one of you passed, you've got the surviving partner, they're filing single, and nobody's ever thought of that. They're like, oh, like I didn't even think about that. Like, well, the two of you aren't going to live together forever and then die at literally the same time, right? And so I need to start explaining to people how that actually works. Okay. All right. Then I'm like, and even if you make it through that, whatever, you still have plenty of money, whatever. You don't mind stiffing the surviving partner who now is filing single and has all these big RMDs. Like you're somehow okay with that, which by the way, nobody ever is because it's embarrassing. Then I'm like, now it's got to go to the kids. They got to, take it out in 10 years. You don't want to do that. You didn't work your entire life so that half of this IRA could go to the government, right? And so that's one part of the multi-generational planning. By the way, it's one of the reasons I love when they're like, oh, I want my son to like sit in on this interview. I'm like, I love your son to sit in on this interview because the second I get to the Secure Act and goes to Christmas future, I'm hired. That kid is like, oh yeah, we need that Debbie Taylor over here, right? So I'm thrilled with that. So that's one aspect of it. The other aspect is the estate planning. Is a big part of estate planning, particularly for these wealthier clients, is gifting, is legacy planning, is bringing in that next generation. And so that's another part of it. And so we've been doing excellent work in those two parts. Don't get me wrong. But the third part, and we haven't been doing as good a part, here, but we are building on it, is again, developing those relationships with that next generation. And so one of the things that we did this year is creating client events specifically around next gen. And interestingly enough, your timing is perfect because over the weekend, we had a harvest/pumpkin festival at this huge farm. It had carousel, all these swing rides, go-karts, picking pumpkins from the pumpkin patch. And our clients brought their children and their grandchildren. And it was an amazing success. I spent over $1,000 on pumpkins because everyone got to pick a pumpkin and make me pay for it. So they decided to get their wealth management fees in exchange for having the biggest pumpkin in the place. And so I spent $1,000 on pumpkins. All right. But it was very successful. We will continue to do it. And many clients were like, I wanted my son to come. He's definitely coming next year, my grandchildren, whatever. And many already came, kids and grandchildren. And so we're doing a number of events. So we did that one, which was crazy successful. We're doing brunch with Santa at our home in December. And who wants to come see Santa? Well, that's the kids and the grandkids, right? That's the grandkids. So we're doing brunch with Santa. And then the third other big legacy event we're doing is those legacy letters is what we call them. And we had specific training around writing a legacy letter, which is different than a will, okay? But why you're leaving your favorite sapphire ring to Julie and why Jimmy is getting the favorite lawnmower and how much you love your children. And there's a whole process around that to provide context and love around, the will and all of that. And so those are three events to help us with that next generation.
Yeah, I was shocked. I saw something from Rick Edelman's group talking about the wars that break out over estates. And, it's huge number, like 40%, 45%, of the siblings, get into fights with each other over what's happened and why. That legacy letter is brilliant. That's a great idea. I've heard other folks who do kind of a video oral history kind of situation, right? Here's where this came from. Here's why it's going to where it's going on next. So, there are lots of ways to attack that. But I think we, as advisors, we need to facilitate those conversations. I agree. It doesn't fit into the to the, what's your allocation going to be for your IRA kind of a box, but it's that relationship piece that so many advisors are struggling with today to reach the next gen. And we've got to kind of put ourselves out there to be willing to facilitate those conversations because, the kids are going to say, thank you. I know because I've had these conversations with next gen and the next gen in families whose money we've managed. And so it pays dividends, folks. Those are great ideas. Great ideas. Before we sign off, what other nuggets you want to drop today? You've done a great job so far.
What other nuggets? I think going into the end of the year, look, you should, for the most part, have your processes ready, between now and the end of the year, right? The Roth conversions, tax loss trading, capital gain harvesting. You're getting tax returns sent to you now because October 15th was the deadline. So make sure you've got your process there. Get those tax returns, run them through Holistiplan. Here's a nice one. And, is get that tax report to the clients. Do not tie it to a meeting. Okay. Don't sit on it. So if the client is sending you that tax return and they're taking the time to do that, you should take the time to run it through Holistiplan and get the report out to them and offer to have a conversation or a meeting around that. And so you want some process around getting the tax return, running it through the tax report, and then getting it to the clients. So that's something that's very real, that's literally happening as we speak. And then what I would tell you, because we're going to blink and before we know it, we're going to be gearing up for the new year and truly year end, is here's what I'd add to your list. Think about this, is sending a year end wins and wows letter. Okay. So people want to know, what have you done for me lately? They forget in December all the things you did for them in January, February, March, and so on. Okay. Like, I don't remember what I ate yesterday. How am I going to remember what my advisor, who I'm paying $40,000 a year to, how am I going to remember what they did in June and in March or whatever? We do a wins and wows letter at the end of every year / first week of January, reviewing the amazing work that we've done for these clients for the year. And so I would encourage you to do that. If you're like, hey, Debbie, that's way too much for me to think about. Maybe just this year, start with your A+ and A clients, and then you build from there. And so that is a firm tradition here, very valuable. I will never give that up. And then the other thing heading into the new year is doing that tax prep letter is what we call. And Holistiplan has a feature where then you can review the transactions from this year and get that to the accountants, get that to the clients so that we can get accurate tax returns and again, provide another layer of support to the clients.
Those are great nuggets. Thank you. Wins and wows. So obviously you when you started this, you probably didn't have the CRM fields for wins and wows, but I bet they are there now, right? So literally, as you're capturing events, meetings, phone calls, and so on, there's the opportunity to kind of flag those nuggets, right?
Yes. And different advisors will approach this differently. So some of them will just have a separate spreadsheet. And when they do something really cool, they'll put in the spreadsheet. Okay, we're all trying to do away with spreadsheets. So anytime you hear there's a spreadsheet, you're like, well, wait a second, is there a better way? Some of them will do in the CRM, like hashtag, hashtag W or hashtag win. And so there are definitely ways within the CRM to be coding it so that at the end of the year, it's easier to pull that information. But one way or another, I think that is very valuable, that wins and wows.
That's great. That's really cool. I like that a lot. I'm sure Wealthbox will pick up on that for us. So this has been super exciting. Thank you very much for taking time out of your schedule. I know you got a million things to finish today. Before we sign off, so Q4, besides burning it up and tearing it up on tax planning and wins and wows, what are a couple of things Debra Taylor and your family are going to do that might surprise our listeners?
You're funny. You want to know, I work hard, I play hard. So we just came back from London, which was a blast. We were there for a week and a half. And we do take a couple days in New York City around the holidays. I'm right outside New York. I love New York around the holidays. And so we act like tourists and we go into New York and do a lot of nice things around the tree and everything.
Yeah, I love New York that time of year. I mean, the windows, just walking around, taking it all in, the smells, the scenes, it's amazing. So,
yeah.
Awesome. Thank you very much. Hey, folks, this has been the Breakthrough Advisor Podcast. This is Debra Taylor. You can catch her on demand on a number of webinars that we've done with her and her past podcasts. Please, when it comes to the Breakthrough Advisor Podcast, make sure you share, comment, like, and subscribe wherever you get your podcast today. So on behalf of Simplicity InsurMark, thank you all very much for joining us today. This is Jack Martin signing off until next episode.
Thank you for listening to the Breakthrough Advisor Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of InsurMark. The content has been made available for informational and educational purposes only.